Hey guys, welcome back to the After Hours. I'm the ATL Beast, and today we're going to talk about your edge and your niche. Now, one of the things you have to know is that trading is not simple, but it can be as simple as you make it. No matter what you're going to do, you're going to have to work hard. One day, you might find some set of rules or a set of filters and match it with a specific pattern. When you combine those three elements, that forms your edge. Your edge pretty much says, based off statistics and my backtesting and the total occurrence of this pattern, I believe I can win if I follow this trading signal this amount of times in this directional edge. We're talking short or long. I could win when these three combine this fixed amount of percentage. That fixed amount of percentage, it could be 25%, it could be 50%. It's usually below 50%, especially if you don't have decent risk management or very strict rules. Once you start to spot the opportunities for profit, you can figure out to what degree can you profit. Within that edge for that setup, there's also another layer, and that's your niche. Now, if we talk about you creating multiple setups and then finding an edge inside of those setups, you're gonna have a favorite. One that you can make the most money, another that you can make the most frequent and consistent money. Those are gonna be part of your niche. There's gonna be niches where you make consistent, small money, and that might be your daily niche, your typical common trade niche. But at other times, you might see setups that show up less frequently, but when they do, they profit a lot and they have a high winning percentage. And when you combine it with the right risk management, you profit in the long run. That might be your niche to make big money, but we all understand that we want that niche to have consistent money. What is your end goal inside of trading? It's consistently profitable, but there's a big difference between the person that profits from their patience and another one that profits from their persistence. It's like the difference between people that trade penny stocks and the people that trade high frequency trading. On one side, you make 100 trades per year. On the other side, you make 100 trades per day. But as long as you're profitable, meaning that you're in the top 25% at the end of the year, you're good. All right, let's talk about what happened this week. Now, this week we had SHOT. Now, this is safety shot. This is another example of healthcare stock. When it comes to the recent biotechs, we understand that biotechs and healthcare stocks, especially during the winter, which is also known as like the season of death, we know people get scared and they throw money at things. Now, SHOT, this was a stock that didn't really have any news, but it ran for 4 or 5 days. Now, when the stock has multiple green days, we call that a multi-day run. When you see a multi-day run, it's very overextended. You count where the volume comes in. And we saw this one started somewhere around $2 or $3. When it went up to $7, it was already at the point where it was on its 4th green day. It had a massive rejection. That rejection was a crack. It was a panic. That was all the people that have been holding this for several days. It was also a mixture of the long-term investors. It could have even been something in the background that you could probably find out in the filings. As a momentum trader, the momentum is leaving the stock. Once enough momentum left that stock, unless there was some type of catalyst that continued the momentum like a balloon, the stock is supposed to deflate. So what happened is the next day, people expected the stock to reclaim its previous high, but then they realized that the stock actually didn't have anything to it in the first place. But when news came out that was slightly positive, there was not a good reaction. At that point, it was too late to try to buy again. It's already overextended. Once everyone knows about an edge, it's usually too late. And so the momentum continued to downtrend, and that becomes the edge. When you see a stock that's barely green following massive amounts of green days and massive amounts of volume, that momentum has to choose a direction. And in this case, it chose to go back down to the bottom of the run. Now, if we look at SGD, now SGD is a real estate company. We traded it last week. We understand that we can use the resistance from last week because it had massive amounts of volume. Now, we didn't get enough of a bounce this week, so the edge on this is small. Now we see the edge is somewhere up here with the resistance, but instead we're under that, which means even if we did top tick this, the reward is too small. The bottom of the run is somewhere around $3. That's the neutralized area. We try to keep trading as simple as possible. We want everyone to follow us. If we're shorting, we don't want to be the first person in. We just want to be in the safest position. When it comes to a small edge play, you could be the first, but you need to be the smallest position because you want to act according to the long run. If you win small, you should lose small. If you have a small edge, that means you only can make a small amount of profit. There's no reason for you to bet the house on a small edge. That's just a recipe to make a very big loss. With SJD, this may have been a win for a few people, but if they try to hold it like SHOT, they would have got squeezed in a day or two. So the small edge is still considered an edge, but we'd consider this a C+ setup, maybe even a D. Instead, we want to go higher to where the profits are more and it's worth the risk, and that makes it a part of our niche. But in the context, the overall edge is there. When it comes to small edges, you shouldn't be comfortable trading them too often because the rewards are not worth the risk. We want to tailor all our risk management to the long term. If you don't make enough money to cover your fees as well as your small losses, it's probably not worth you even trying to trade that, unless you can manage your risks to the point where your losses are smaller than your wins. It gets really complicated. If your big loss is equal to 3 of your normal wins as something that's unrecoverable, that's why we don't like small edges. What if we flip that around and do a normal edge or a big edge? Maybe you can get 3 or 4 losses and that equals only 1 of your wins. But alright guys, that's all I got for you today. If you like what you saw, hit the like and subscribe button, and I'll see you in the next video. Peace.